Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonneau, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Jack Forehand is a principal at Volatility Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Volatility Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility Capital or Sunpoint Investments.
So, Matt, apparently markets are in turmoil, from what I'm being told.
Panic, Jack, panic, turmoil. It's all going.
They did break it out, though, right? I believe very recently they did break out the markets in turmoil episode.
Serenity now. I guess so. I mean, it sucks. Like this stuff sucks. This is not the fun time to be in markets. It's not the fun time. I don't know what it's like for you, but it's like, I've been on a phone for a week and a half at this point, 2 weeks while we're recording this. Like I just live on the phone talking to clients. And not that anybody's panicking, but it's just like, I just live on the phone talking to people. So this is life. Sometimes the world tries to end and it's our job to help navigate it, which is, I think, is what we're here to try to do. We're going to therapize each other. Is this what's going on?
Yeah, absolutely. I think this is just for us. Yeah, I know nobody's watching. This is just for us. But I want to go back to that thing on the phone too, because later on I want to talk about how you and I do that, because those are very interesting calls. Like I've been having some myself as well. And those are very interesting calls to have with people. And I want to talk about like how those go and what we think about the process. But, and I was wondering, by the way, on the CNBC thing, I'm wondering like, who is the person that has the criteria in terms of when we break out the markets in turmoil episode? Because it seems like they're coming out a little sooner than they used to. It seems like maybe the turmoil is getting stretched a little bit relative to, I think our max decline, at least closing, was like 8% so far in this decline for the S&P, and we've got the turmoil thing out there. So I'm wondering like who makes that decision?
This was a very eye-opening moment for me. It was a number of extremely eye-opening moments. This is basically in the thick of the financial crisis. It's not a conference, but it was like a bigger meeting of a bunch of people at my old company. And we had a couple of the CNBC talking heads guys were there. We were in Connecticut, so they weren't that far. Some of them occasionally worked where I was located, like in a building across. So it's not an abnormal thing for them to be around, but they're around, and it's a, small conference room. So not like thousands of people, like less than 100 people. And we're having this conversation, and this person basically started to talk about how the ratings drive this stuff. They're like, our ratings are 100% correlated to the VIX. And basically, as soon as we see a spike in ratings or a spike in volatility, like a spike in volatility just leads ratings ever so slightly, and we lean into it. So this was a global financial crisis era comment. And it was basically like, if there's an upward trajectory in the VIX, we know we have a rating spike. My hunch is that they've just gotten smarter about that over the last, 15 years here. And it's just like, oh, the VIX went up. It hasn't been up in a while. The ratings are coming in. Throw all the ratings grabbers that we got down these people's throats. Let's say something crazy like the Dow just had its greatest, single point drop day ever in the history of the Dow. It's like, does no one understand math anymore? Like, yeah, it's going Lewis Black mode over here. But
what I like about this is you might be telling me CNBC are quants, because you might be telling me there's some sort of code behind the scenes that says, if VIX spikes to this level, release markets in turmoil episode. So yeah, maybe they're like me.
All advertisers, all marketers are quants. I have books from the 60s about marketing. The marketers are quants. You can't talk about markets without talking about marketing. Every time somebody is selling your eyeballs, there's a quant behind the scenes pushing that button. It's amazing.
So we're going to talk about how to navigate this type of stuff and maybe some of the lessons we've learned. But first I want to talk about what's going on, because I think it's important. A lot of times people will just, like long-term people like me, and we'll talk about this a little bit later with the lessons, will just be like, stay the course, don't worry about it. But, this stuff is in front of us every day. It's interesting. I think education is good. So we want to go through and just look at some of the interesting things that happened recently that, are sort of outliers. And the first chart here is talking about, and this obviously is no longer true, but this idea of how many days we had without a 2% one-day loss. So one of the things we had going into this period is an incredibly low volatility market. You think back to like 2017. I don't think it got that low, but it was a similar type situation. And you can see in this chart, like you have the number of days without a 2% loss. And then this is from Brent Kachuba, Spot Gamma. This is from the podcast I do with him, The OPEX Effect. And like you can see, a lot of times that breaks eventually, and there's some sort of event that breaks it. And so you can see, like, going back here, he went back all the way to 1995. I mean, you've basically got, in terms of like the significant spikes here, you've got the tech bubble, you've got the GFC, you've got Volmageddon, and you've got this. So it's interesting. Like, this was one of the longer periods in history without a 2% loss prior to what just happened recently.
I think about this. I think about the old Nassim Taleb used to use this story all the time. I forget which book it was in, but that thing about the California forest fires. You remember this story? You know what I'm talking about?
Vaguely.
And the metaphor was basically the forest fire policy was to basically put out every single fire as soon as it started. As soon as there was a spark, as soon as there was a smoke, we wanted to get on it, make sure it doesn't spread. And what happens is when you put out every single forest fire immediately before it becomes a forest fire, every single mini fire, you get this weird little sawtooth thing that lulls you into a false sense of confidence. Because when you do get a spark that spreads faster than you can put it out, you haven't cleared the brush and you get the mother of all forest fires overnight. When I look at these volatility complexes, regimes, and all the other stuff, and Brent's way smarter than me, so he's the one to ask this question officially too. But it's like, we get these little bursts, and I don't want to say it's predictable that we get the burst after a lulled period, but in a way it kind of is. The longer you're in that lulled state, the more likely it's going to get. You're going to get a vicious spike at some point that's going to clear all of that brush. And that, I love seeing it pictorially referenced this way, because it just shows you how dramatic this is. These charts actually, I think, the vol charts show us more about how this actually feels to have money in the markets when this is happening. Because all the other numbers in this decline are kind of, all right, garden variety, a little bit of a price decline, don't worry about it. But this vol chart tells you what this feels like right now, which is holy crap, what was that sound? What just blew up in my house?
Yeah, it's interesting to know. I mean, you can't do a lot as a long-term investor, at least. You can't do a lot with this because, again, you don't know how high that line was going to go before it broke. And you know even you don't know what degree it's going to break. I mean, we've had a decline here. We haven't had a massive decline. I mean, we certainly have anything in near what happened in the GFC. So you don't really know what's going to happen with it. The timing of it's impossible, but it is interesting. And it just shows, I think one of the things we are seeing a little bit more in markets, and I don't know if this is rising options activity or what it is, but we are seeing more of these like extended low volatility periods followed by pockets of like tight high volatility. And so as an investor, I just think that's something you want to have in mind. Like, so when you see that type of thing, you're not saying, oh, this is crazy, we've never seen this before. Like that's what's happening now. You know, and also you don't get lulled to sleep by the low volatility to think like this is going to go on forever. We don't know how long it's going to go on, but that seems to be the type of market we're in now.
Yeah, I think what you just said is the key. Understanding that these are just periods that we seem to be going through right now, and having the expectation, because, and granted, this dragged on a long, long time, but having this expectation of like, as that volatility stays low, as it's not punctuated, you don't get the big one-day declines, you don't get any of the bread thrusts or any of the technical stuff that a lot of people in our shoes look for. You start to go, hey, one of these is coming. And then you want to understand when it's happening. I know we'll talk about this too. In the same way, I'm scarred by the global financial crisis and the amount of time for that recovery to take place, and that whole fall into spring period of like the giant swings that we saw, just how nauseating and the stuff getting beaten to the ground. I'm also scarred by what happened in COVID and just how quickly you had to flip the way you were thinking about this thing, because it can turn on a dime too. Really easy to shoot yourself in the foot when this stuff goes haywire. Long-term investors know this, but it doesn't mean you feel it when you're going through it.
Yeah, so this gets into kind of what I put next. This chart from Charlie Bolello. This VIX spike we saw on Monday was the second largest VIX spike in history. So it just puts it in perspective. Like if you think about some of these other ones in history, you had some, and we'll talk about this in a second, you had some significant events going on, but this was a very large VIX spike. And then also, to get to your point you just made, the largest VIX decline in history was the next day, after the second largest spike in history. So like, if you just think about that, that's very interesting, especially given what's going on in the market right now, to think about that degree of volatility.
These really highly punctuated events are just part of the new normal. This is part of markets moving faster than they've ever moved in history. And it's got to be some of the derivative contracts. Like what do you know about this aspect of it? It's got to be some of the other vehicles and some of the other things that exist in this day and age that can make 2018, 2024, and then, a couple in 2021 right behind it in that top 5.
Yeah, and you don't know, like, especially as long-term investors like us, we're not sitting there looking at the plumbing of the market all day. Like, we don't know exactly what happened. People talk about the yen carry trade. People talk about somebody had to be, given the way it happened, somebody blew up behind the scenes, and we'll find out later who it is that blew up, and they might still be blowing up, but we're not even sure. So, like, there's mechanics that go on behind the scenes in terms of what drive flows. I mean, if a major player is forced to reverse, massive positions, you can have massive knock-on effects to that. So, like, we know that could be what happened here. We don't know for sure. But it's just interesting, like, as a long-term investor, if you think about it in a long-term context, it doesn't matter, but it's interesting just to think about it, because when you start seeing these things that you haven't seen in a long time, you start to worry about some systemic problems. And sometimes it's not a systemic problem. Sometimes it really is just some player got on the wrong side of things and things blow up, and then you return a little bit closer to normal after that.
Yeah. It's the thing where it's like, oh, this drain seems to be going slow in my house. And it might mean the roots have grown into the main line and it's a disaster just waiting to happen. Or it could just be like, oh, the drain got a little slow because, the hand soap built up over time or something stupid. We don't know based on this stuff. We know that the Bank of Japan they've been experiencing slightly higher inflation than expected, or higher than expected, I should say. And the Bank of Japan raised rates, and there's all sorts of plumbing stuff that just comes with that people will tell you they understand. I'm still convinced nobody really understands what happens when these mechanisms move. And
I agree.
That's the important takeaway, to know nobody really has. There's no model that you can build that perfectly describes the way this thing works. So if there's no perfect model to explain these things, we just know weird stuff happens when stuff like the Bank of Japan raises rates and the Fed's considering it and inflation's going in 2 different directions and whatever else. I take some solace in that unpredictability about what just happened in the last week, that some of this is just, there's no way for you to know. The only thing you can do is what you're going to react to this thing, and if you're going to take any bigger clues from it or not.
Yeah, and then going back to your drain example, like, there's probably some times where you use the Drano to get the drain going a little bit faster, and there's maybe some times where you got to get the explosives out and blow the whole tub up or something. And like that's what you kind of see with this stuff, is like sometimes like the extreme measures have to happen, and there's not enough, that can flow through the drain, and you got to make the drain bigger. And you end up with these huge moves in the markets because people are forced sellers. They have to do whatever it takes to unwind whatever their positions are, and that's when you end up with these problems.
So much of financial planning boils down to just this idea of never be forced to sell, never have a panic force you to sell, build your portfolio in a way that you're not forced to sell. It should always be an active choice to sell. When we see a decline of this magnitude on a given day, I try to remind people of that too. Like, the point here is somebody just got forced to do something they didn't want to do.
Yeah, and you would think, the institutions would learn that lesson, but they don't. You always still, over time, we're always going to have these major players in the asset management business that are going to think, because of their models, this can't move while this in this direction, while this other thing's moving in this direction. And, their model said there was a 1 in 110 billion chance it would happen, and it happens, and then they blow up. It always has happened. It's going to continue happening. It's just part of what's going on. And go into this next chart. I thought this was really interesting from Brent Donnelly, because this gets to what we were talking about. Is like, it's kind of a funny chart, but it just shows what the VIX spiked to and how it compares to other things in history. And I mean, all these other things on this chart are like major things in history that happened. And then he's got slightly weak payrolls on the other side. So that tells you there's probably something else going on we don't know about here, because getting a VIX spike to 60 on, slightly weak payrolls is not something you're likely going to see. So I don't know if it's the yen carry trade or somebody blew up or what it is, or just repricing expectations really quickly, but that's not typically a spike you would have seen on the type of payroll report we saw. I mean, we didn't see we still added jobs. I mean, we didn't see like the worst payroll report of all time. Like, there was so far, it was slightly weak payrolls, and like everything just blew up. No, who knows why? I don't know.
First off, Brent and the Friday speed run, like, if you're not subscribed to that, just go subscribe to it. It's so good. That's on my very short list of things that I need to look at constantly. Brent's a brilliant guy. We're going to get him on the Intentional Investor sometime soon too, because he's just fascinating. But this point in this chart, like, again, look at the size of that. Look at the size of the spike that we just had on this thing, and realize how hard it is to attach one of those labels to it. Like, and it's funny because we could say weak payrolls. I'm sure there's a mainstream media, there's a CNBC, there's a Fox News, there's a MSNBC, whatever thing that says like weak payrolls drive market through the floor. There's that headline exists somewhere in the world, but just tagging in slightly weak payrolls to it, because this is the situation. We didn't have a singular economic event that's global pandemic, the Chinese devaluation of the currency. And we did have, to your point, and maybe this is how the chart gets amended over time, that differential between what the BOJ policy and what the Fed policy is. And that's really the only thing we can point at and go, that's something that a lot of money responds around. Somebody probably had a bad model constructed. And that goes back to the beginning. You can't model the whole system. So we have to deal with some of this stuff when it blows up and recognize something probably just broke. Somebody call Roto-Rooter.
So let's do one more chart before we move on to lessons from this. But this one is really good. It's from Noel Smith on Twitter. And this kind of gets at why you had your Markets in Turmoil episode here is, there's a relationship over time between how much the S&P 500 goes down and how much the VIX spikes. It obviously can change a lot over time, but there's something you would expect in terms of what a VIX spike you would get given a decline in the S&P. And you can see here what we got on Monday compared to what you've seen in the history in this chart. It's all completely off the chart. Now the stuff on the bottom is more of a moving average, so it is averaged out anyway, but still, like this is an off the chart spike. It was 8 or 9x the VIX beta to the S&P. Which just shows the degree of whatever it was that happened. And maybe in the course of time, we'll find out what happens, how rare it was to see something like that.
It's important to remember, and there's a bunch of math that I'm not entirely straight on going on in this chart, but I'm straight on at least this much. The beta is just a way to measure slope. And what this says is it's basically like, I don't know if, did you ever roll a super ball down a hill? I grew up in a valley. This is the kind of thing that should entertain ourselves with.
I definitely remember doing it down a flight of stairs a lot.
Yeah. So like you roll it down a hill and just assume pavement on a hill, and we're going to ignore all the potholes in the part of the country I grew up in. So you roll the super ball down the hill, and at first it just rolls like a ball, but then inevitably it's going to catch like a weird pocket or a piece of gravel or something just the right way. And the further it's gone down the hill slope until it hits that little thing, and then would go rocketing into the air. And it was just crazy to watch. And then that rocket means there's going to be another huge bounce, and then whatever else. And sometimes it would bounce and then drop again and then roll again. We're looking at slope. We're looking at something that just blew off of the charts on this thing. We have every expectation of this to converge again at some point in the future. We'll see how exactly it converges and smooths itself out. But it's really interesting. And again, another point of this is why this is an outlier. It doesn't normally do this. Somebody rolled the super ball down the hill. They thought it was a bowling ball. It turned out to be a super ball, and it just went bananas. And another indication that call Roto-Rooter.
So we're going to put all this in a long-term context in a second, but I did want to talk a little bit about, there's always, it's very good to put things in a long-term context and understand, things repeat themselves or at least rhyme historically, but there are things that are different every time. And I think it's important to understand those. One of the things that's different this time, and we've talked about it before, is options activity has risen a lot. Way more people are using options than were before. Do I know what that means? No. I think that probably has a lot to do with the muted volatility followed by the spikes. But again, I'm not an expert in options. You can watch the podcast with Brent to get a better perspective on that. But I think it's good to understand that's going on, because maybe it helps you explain what's going on. Or we've talked to Mike Green a bunch, and you and I did an episode about lessons from Mike Green about the rise of passive investing. That also is having impacts, that could make the market more volatile. That could increase the chances of these spikes if passive were ever to go negative. So that's important to think about as well. And the other thing is, and this is outside of my area of expertise, but a lot of the guys that I do follow are talking about, like, beneath the surface, they're seeing less liquidity than they had seen in the past. And, that could relate to some of these other things as well, but there are things going on that are different this time. Now, what those mean, I don't know. What the impacts are for long-term investors is probably nothing, but I think it's at least good to understand what you're seeing and what might be driving these types of things we're seeing in the market.
It's good to know these are trends. It's good to read like the Mike Green stuff. It's good to read. Dave Nottig had an exceptional piece. I don't know if you saw this, but
yeah, I read it. It was great. Really good.
Why the active passive debate matters, and kind of like looking at the concerns around passive and what this means. But these are all understanding that there's just more passive than there was in prior cycles for something like this. There's more options activity and people trading options than there was in a prior instance of something like this happening. These are all going to change the way we take the next turn in this economy. So reading stuff like Noddig's piece, paying attention to stuff like what Mike Green and people like that are saying, they help give color and context to the broader situation we're in, because the world, human behavior doesn't change, but the world does keep changing. And there are some very, very substantial differences in things like passive investing, in things like market plumbing, in things like options activity that just weren't quite this way before. So anybody who can help us put that color on the situation can be really useful, because that's also part of how we can look at this and make a joke like Brett made about like, yeah, the payrolls are kind of weak.
Just to close this out with some positivity, because we have talked about some things that are a little bit weird in the market. This is great. You pulled this from Charlie Bolello. And this is basically the returns of the S&P 500 following CNBC Markets in Turmoil episodes. Now, just to put this in context, this is not, great. Like my quant friends will tell me this data is not, great. There's a lot of days that are basically one after the other, and the 1 year periods completely overlap. The sample is small. That's not the point. This is some like perfect test. But the idea is what the average 1 year return following a CNBC Markets in Turmoil episode is 40%. And he said percent positive 1 year returns always, 100% of the time. So again, there's no statistical significance to this, but it does show, like, when you see this in the media, when people are panicking, when CNBC is breaking out the Markets in Turmoil episode, a lot of times it's not a time to panic, even though it seems in the time that it is a time to panic.
This is the new blood in the streets, for the most part, if anything else. And maybe this is just a buy the dip mentality of the last however many years that's been working as well as it's worked. But it's, if CNBC or if the mainstream media is running a Markets in Turmoil thing, that's kind of your blood in the streets lately. And savvy investors, it's good to see a chart like this, especially as a long-term investor. It's good to see a chart like this, because this is a reminder. If they're covering it, that means everybody knows. And if everybody knows, that means there's something else that everybody doesn't know. And that's really what you want to be paying attention for stuff like this. I love this graphic. I hope he updates it. I hope he continues to update it. That's a Madoff sea of green right there. You wouldn't believe those numbers under normal circumstances.
What's crazy about this, and this plays into what I was saying before about the numbers maybe not be something you should rely on, but also, like, once CNBC breaks out this Markets in Turmoil episode, they keep it out. Like, they don't play games here. Like, this is like, if you look at 2020, like starting in February of 2020, they were like running this thing every day for months. They kept running it over and over again. So I guess when they see the ratings, they're ready to go with this thing.
Hey, fear sells. Fear sells really, really well. It goes all the way back to all the Danny Kahneman stuff, and putting your hand on a stove is way, way more memorable than, having a good thing happen to you on your Tuesday morning. So if they know that people are concerned, they know the best way you get you to turn that TV on again, to log into that website or whatever the next day, the best way they can do that is just to prey on something you're scared of. So being an educated consumer, not just becoming hugely desensitized to humanity, which is the risk of all these things, but certainly feels, man, I'm just so much more jaded and cynical with so much of this stuff than I was 10, 15 years ago. It's crazy the callous I feel like I've built up as a professional dealing with this. Have you experienced the same thing?
Yeah,
I
you
haven't had this
can't
level
help
of
but do it. Yeah.
I haven't had this level of jaded cynicism since I was like an obnoxious, like 14-year-old atheist or something. Like, what? They said this. Those guys.
Yeah. Well, so that's something we could maybe talk about in a future episode, like how to deal with that, because you're right. I see the same thing. But pivoting to our lessons. So I think the first thing I want to talk about here is, I think a lot of people might look at what we've talked about here in the first 22 minutes of this podcast and be like, why are you even talking about this stuff? Like, you're a long-term investor. Nobody cares about this. Like, if for long-term investors, they shouldn't even pay attention to this. And I think I've learned over my career, because that was me at the beginning. I think I've learned over my career that that's the wrong way to look at it. I think when people who are your clients are paying attention to this stuff, like, you have to address it at least. You can't pretend it doesn't exist and be like, oh, what are you doing looking at a VIX chart? Like, that's irrelevant to anything that's a part of your long-term plan. That's true that it's irrelevant to anything in your long-term plan. But it's also true that, and Ritholtz kind of talked about this, like when their clients used to call and talk about individual stocks and stuff. I think Josh Brown talked about this a long time ago. Like, they would just dismiss it at the beginning, but it's like, your clients want to talk about this stuff. They're thinking about these things. So what I said is education is better than ignorance. And what I mean by that is I think it is important, if you're looking at this stuff, I think it's better for people to understand what's going on here rather than just to dismiss it as if it doesn't exist.
I talk a lot about in my away from the stuff that I do away from work for myself. I talk a lot about basically how your curiosity drives where you're creative, that drives your habits, and your habits have to point back to like noticing what's going on in the world. This is connected. Clients want to talk about an individual stock. Clients want to talk about that levered triple reverse, VIX ETF or whatever it is. They want to talk about this stuff and don't dismiss it. As a professional, I believe it's our job not to be dismissive of that. I think, and this is something that I bring in from like the cultish creative stuff that I do too, where I want to notice where your curiosity is getting stoked. I want to notice what's grabbing your attention and why you want to do that. Because I know, just like me in like 4th grade math, the first time I stumbled on fractions and was like, I think I'm done with this. I want to know that if I have something that's forcing me away, I'm not going to miss out on something I need to learn later. And likewise, if I have something that's super, super engaging to a person, there's probably a through way to explain some other stuff that actually matters that's inside of this thing. So if what just happened in NVIDIA has a client's attention, I want to jump all over that curiosity because I know curiosity is just the beginning of the conversation. Why are you curious in this thing? What can we do creatively with this? What can we process this messaging to do? Which education, that might mean talking to somebody who has no care or concern about the yen carry trade, what this is, why this matters, and why that it means it might be okay that we don't know exactly what's going on now. But I'd rather have it be that than unemployment just tripled for no reason overnight because we just, bankrupted a bunch of banks or construction companies or something. And then the habit of like, okay, what are we going to do with this that's constructive? You might have come to me with a very idiosyncratic thing that I might have very little to do with in your financial life. But by the end, I want to bring that back around to something that's informed, that's educational, and that's interesting to you, the client, to the person who's reaching out, because anything that stokes your curiosity is valid if we work through that cycle together. That's part of building a relationship. That's part of where trust comes from.
And so much of this is different for different people. Like you also don't want to be on the other side of the coin. If you have a client who doesn't even know what's going on, who, just basically doesn't pay that much attention to their investments, you want to be like, call them up and be like, did you see this yen carry trade? Like, you don't want to do that either because but for people who are interested in that stuff, like, I think it's important to talk about it rather than dismiss it.
When my 4th grade math teacher was like, you're bad at fractions, and now on this snow day, I'm going to make you watch Shirley Temple movies. It's like, I'm double uninterested in this. Just let me go on my way. It's just better for all of us if you just dismiss me from the class right now. No good is coming of this. And yeah, for the long-term investors who are like, this is what markets do. And I've had a bunch of those calls too. Hey, everything okay? You worried about any of this? Like, Matt, you know me. Like, this is a walk in the park. Oh, it went down for a couple of days. Just tell me you're rebalancing or we bought something. Like, that's what I want to know. And for every one of those, there's somebody else who wants to get into the weeds on it. That's why you build relationships with people you can trust, the people you can talk to. And that's why for us in this seat of working with people, it's just, if you're curious, I want to go deeper. If you're not curious, let's figure out what you are curious about for the next conversation or the next thing we actually have to talk.
Betterment did a good study on this a while back where they tested all kinds of ways to reaching out to clients during market turmoil. And they found, like what I was saying before, was not the right way to do it. Like, you don't want to basically reach out to people and say the yen carry trade is blowing up. Like, if you have any questions, reach out to us, because a lot of people don't care and aren't paying attention, and you're stoking panic where there's no need to stoke panic. Whereas the people that are a little bit more concerned, you can either identify them in advance or they can reach out to you and then you can address these types of things.
I like thinking of it as it's not our job. We're really picking on CNBC. I don't know does it matter? Are we just okay picking on CNBC?
I think we're fine with it. Yeah.
We're fine picking on CNBC. Okay. So that's the wrong approach. Like, the wrong approach is me to pick up the phone and be like, because people pick up their phone, put your AirPods in, call the person and be like, markets are in turmoil. The government is under push. That is not a good approach. You can call and you can react to that. You could say, I don't know if you saw the news today. Stuff's bumpy out there. We're okay. Are you okay? There's a million other empathetic ways to do this, but just, don't, as Betterman showed, like, don't run into the theater screaming like fire and then be like, no, on the movie, there's Prometheus is there. It's okay. Like, what?
So anyway, my next one is also, I think it's the corollary to this thing. So we're talking about all this information, we're educating ourselves about it, but you always have to ask yourself the question, what can I do with it? Because that's when it falls down. So we could talk about VIX spikes and we could talk about the yen carry trade and we could talk about all that stuff. But as an average investor, what am I going to do with that? The answer 99% of the time is absolutely nothing. I'm going to educate myself about it. I'm going to understand what's going on in the market. So when I see these CNBC headlines, I maybe have a better view on what actually is happening. But like that next step is so important not to take it, which is I'm going to take this information and now I'm going to start thinking I got to make changes, because that's when you get yourself in trouble.
What can I do with this that's helpful to my future circumstances? This is where I love having the written financial plan with clients. I love knowing the calendar events. I love knowing the expected cash flows. I love knowing the balance sheet. I love having the balance sheet segmented into at least 3 components of our short, medium, and long-term money. So we can say, what can I do with this? We know the market just went down. We know that creates buying opportunities over the long term. How much do I have in short-term money relative to my short-term cash flow needs, relative to what's on the calendar and whatever else is going on? If I can use this to be opportunistic, declines are the times to be opportunistic. Just like 2 or 3 months ago when we were basically on back-to-back double-digit S&P returns, at a minimum, where it was like, it works in the other way too. When markets are giving you consecutive above average results, press rebalance. Take the risk, at least back down to your target weighting or whatever it is across those 3 buckets in the context of your broader financial plan, because that's how you answer the what can I do with this information. Critical. Just don't be forced to do anything. The minute you let somebody else force you into how to decide or how to react is the minute you're getting into trouble. So having that long-term plan, knowing how to stick to it, also informs what you can do about market events like this. Talking to a lot of people in the last, week, where it's just like, we don't need as much money in the short term or the medium term bucket. Can we do something proactive about this? And that's not saying like go out and buy the dip, but it is saying if you rebalanced 2 months ago when the market was ripping, you might want to rebalance again now, because this moves the balance out of whack. That's why we rebalance.
Yeah, unless you were somebody who had the levered yen carry trade on, which I assume you probably did. But unless those people probably had to head for the exits very, very quickly. They probably had to take immediate action on this. But your average investor probably doesn't have to worry about it too much.
I only borrow yen, as you know. So is Kyle Bass okay? Say, check it. Did this work?
That is true. He may borrow yen. I'm not sure
now, or is he worse? The math on that one's always confusing to me.
So my next one, and this is sort of in contrast to what we talked about before, but the next one is we've usually seen something similar before. And we did highlight some of the differences now in terms of what we've seen in history, but we asked Matt Faber on this podcast we just released today about this. We were asking about all this stuff I talked about, like rising options activity and all this other stuff. And I'm like, does it change anything for you? He's like, absolutely not. It makes no difference. Like if you go back in history, you'll see similar types of things. You'll see things that happen that nobody expected. Like this is all kind of par for the course of investing. And I think that's true. Like it's good to look at history and maybe find something that rhymes, because it at least gives you some context in terms of what happened after and how things played out. It wasn't the end of the world. And so I think it is good for us to educate ourselves about history, even if things might be a little bit different this time than they were in previous times.
I try to remind people on this one with the something similar. Similar is not same. Those are 2 different words. And a good way to think about this is think about, if you're a sports person, think about the evolution in sports. Think about in baseball, adding the pitch clock. Think about all the other little like tweaks. If you're a soccer or World Cup person or whatever else, you think about the substitutions and the things like that. If you're a music person, you think about the evolution in styles and the things that are callback to past periods, but totally updated for modern times. Nothing culturally stays exactly the same, because different generations grow up with different experiences. This is the great part of all like the Fourth Turning and Neil House stuff. Like the really great part is that different generations, different people process information in different ways. And then they get older on average. And that means stuff keeps getting moved forward in a different way. So you can see stuff that's similar. It's not going to be the same. And to Meb's point, we want to step back and go, what about this actually informs the decisions I'm making? And unless there's something really major that I see that's going to inform those decisions, a lot of this I should just expect. Let's look at other times things acted similarly to what's happening now to take our biggest cues from.
So my next one here is stocks always climb a wall of worry. And I think this is important because to me, the times to be worried in markets is when nobody else is worried. Like 1999, for example, there may not have been a wall of worry. I mean, there probably was on the way up, but eventually it went away, and eventually it was the internet's going to change everything. And maybe we get to that with AI at some point. I don't think we've got to that yet, but maybe because there's been tons of things to worry about recently, but maybe we get there with AI where everybody's like, AI is going to change the world in every way possible. So to me, like the worry is something that's good. You want it to be there. You want people to be doubting the rally. You want all that to be going on. It's like, so it's just, I think it's important to understand this is par for the course in investing. And so if you see these things to be worried about, whether it's the yen carry trade or anything else, just understand there's always something to be worried about. And one of the things I've found for myself is I try to write these things down sometimes. And like, I put them in like a Word document because it helps me to go back 3 years later and be like, oh, I was worried about this and I was worried about this and I was worried about this. And usually they resolved in a positive way. And usually there wasn't a reason to be worried about it. So this worry thing is normal. And most of the time, the thing you're worried about, the market ends up overcoming that thing.
I believe it was a Josh Brown thing, or one of the people who I saw put it this way the first time. This is a long time ago. We climb a wall of worry. If we didn't climb a wall of worry, then stocks should basically trade so that in returns are commensurate with, T-bills or treasury bonds. Like the 30-year bond return should like match up with the treasury bond, because there's no point in taking risk. If there's no risk, if that's truly what we believe, that there's no wall of worry there, then the valuation should be through the moon and stocks should be priced like there's no risk. If we're not seeing that, there's going to be some variance in what the path is, and that's where risk premia and all the other stuff comes from. So the wall of worry is a feature, not a bug. We have to anticipate stuff like this over the long haul. That's what gives us our opportunity set. That's what gives us these trade-offs. And that's why for anybody who has like needs for that money, they're not going to be just invested in stocks. And for people who are doing it in some deliberate way, they're going to figure out what part of my life can I risk on my favorite example? Like, what part of my money am I going to risk on the McDonald's of the world, figuring out how to price the chicken nugget, of the Apples of the world, figuring out how to price the iPad, of the NVIDIAs of the world, pricing out whatever the name of the fancy chip is. Like, the reality is we're betting on companies to make these decisions to try to figure out how to be profitable and give a return higher than the risk-free rate. It's the wall of worry. It's a beautiful, beautiful wall of worry.
This next one I really love because, and this is from Aaron Stanhope of O'Shaughnessy Asset Management, who I would recommend anybody follow on Twitter. He doesn't tweet a lot, but when he does, it's always really, really good stuff. So this gets at what we've talked about a lot in the podcast, which is this idea that fundamentals don't matter and you throw them out the window and whatever. But like this chart is basically fundamentals, which is earnings per share, against the Russell 1000 total return. And you can see over long, long periods of time, it deviates at times, and it's deviating a little bit right now. But in general, it always comes back. And so for people like me who are worried about, is the market not responding to fundamentals as much as it did in the past? Like, I think this is a really cool chart to look at. Just to put it in context and realize we are buying shares of companies, and we would expect that over time that the shares of the companies would do something similar to what the fundamentals of the companies do.
Aaron is such a thoughtful guy. It's such a great reminder. This is a big part about things we go over with clients on a regular basis too. So clients who have stock allocations, we want to remind them of, yeah, it's concerning when company fundamentals all flatline or when they're declining and stock prices are still up or trending higher. Seeing the reminder of this, of just going like, okay, like fundamentals haven't rolled over hard. This is just where we are in the trajectory of things going up. Back to, I know I said it kind of as a joke, like the biggest Dow single point drop in a single day. Well, yeah, that happens because the value of the Dow, the points value of the Dow is way, way higher than it was a few years ago, let alone 10 years ago or whenever the last statistic came out. It's the same thing here. Like the rate of change and the absolute value of free cash flow, earnings, of revenues, of all this stuff, when we look at broad market indices, it's going in the right direction. It's going in the right direction. It's working. And that's a beautiful, fantastic thing to focus on. That's not a headline.
And the big important question here is, why am I buying stocks? And I think this gets at that, because what I'm doing is, so if I ask myself the question, do I expect the fundamentals of US companies to continue going up over time as they have historically? If the answer to that is yes, then the second question becomes, do I expect the stock prices to actually track those fundamentals? And that second question is where people have been doubting it recently, but this chart kind of puts it in context. Yes, over time, I would expect if the fundamentals continue to go up, the stock prices will continue to go up. And inside of that, we can debate whether small caps are, tracking fundamentals as well as large caps, or NVIDIA is deriving all of it. But for people who are just invested in the market in general, this is a good reminder that fundamentals do track, price does track fundamentals over time.
It may be a wall of worry, but fundamentals aren't fun.
And this second one from him is also really, really interesting, because this gets at a lot of what we've been talking about that some people have been saying is not true. And this is talking about the total return for the Russell 1000 index, and then looking at it in terms of like relative to fundamentals. So, and comparing it to the tech bubble, because a lot of people have been saying we're in the next tech bubble. And this chart really contrasts that to show, and this is from Aaron Stanhope again, this chart really gets at the idea that is not backed up by the data. This tweet I put up, he said, since the pandemic, SPX has returned 13.3%. Free cash flow has grown right at the same pace, a far cry from returns outstripping fundamentals, i.e. dramatic multiple expansion in the tech bubble. Analogs are imprecise, but provide good perspective. And so that's the idea that we are seeing something very, very different than the tech bubble here. We're seeing most of this being driven by earnings, being driven by fundamentals, and a lot less of this being driven by multiple expansion than we did in 1999. Now, that doesn't mean it'll continue. We may have the AI bubble coming in the next 5 years, and some of the guests we've had in the podcast have suggested that might happen, where this gets completely out of whack. But at least for right now, most of this has been driven by fundamentals.
And it's important to do what he does here too. I really love that, because I'll see a version of earnings with this chart. You see a number of people who publish the earnings version of this. You'll see a number of people who publish a revenue version of this. Seeing free cash flow, anybody who normalizes for things just besides market cap, it helps too that he's using the Russell 1000. These are all just little tweaks to the data set that kind of just help remind us, are we kind of on track, or are we, way, way out of whack? I think you want to pair a chart like this with a chart of like the Russell 1000, valuation bands with 1, 2, and 3 standard deviations, or 1 or 2 and then more away from like the averages over time. This is a good centering exercise to put next to a chart like that and go, yeah, on average, large cap valuations, a little bit stretched, not nearly as stretched as they've been in the past. And critically, they've been stretching a little bit up until very recently, because things like free cash flow have actually stayed right there. Stocks for the long run, like you said.
So this next one is also, this is one I like to pull up whenever I see any sort of problems in the market, because I think it puts everything in context. And this is basically looking at the percentage of days in the S&P 500 that are positive. And as we move forward, percentage of months, percentage of quarters, years, 1 year, 10 years, 20 years. And you can see, basically on any given day, it's almost a coin flip. As you get to weeks and months, it's still the same thing. You can have a lot of periods that are negative, but as you hold longer and longer and longer, there's never been a 20-year period where at least nominal returns in the S&P 500 were negative. And it's just important to keep that in mind, because you can get trapped in this daily returns only being up 53% of the time. And if you think about it in that time frame, you can get, stuck a little bit. But as you move forward and think, when I get out to 10 years, I've got a really, really high percentage, I'm going to be making money. And then when I get to 20, I've got 100%, at least historically. I think that's a good way to look at it.
Yeah, this is the antithesis to the markets in turmoil, like run the story on CNBC. On a daily basis, when you have this stuff happening, is a great time to run markets in turmoil. There's no 25-year like average. And certainly they're not pulling out the 25-year anniversary of the time we ran markets in turmoil and we're wrong. Like, they're never going to run that thing. So if you want to sell ads, you sell them on the daily returns. You don't sell them on the 25-year anniversary of the time you screwed up 25 years ago. So help me God if I have to revisit mistakes made 25 years ago. Those are dark days.
That could be a long episode if we ever did that.
We'll skip that one.
The only other thing I'll point out about this is it is important, and this is sort of a corollary, but it is important to remember the types of returns you're seeing. So this is nominal returns, but there's other things you see reported, which is, real returns. So how did stocks outpace inflation? You see the risk premium. Did stocks outpace treasury bills? And so when you see charts like this, a lot of times, depending on what they're done, how they're done, you can see different results. Like, I think that 20-year result is different when you look at it the other ways. Like, I don't think stocks have outpaced inflation in every 20-year period. I don't think there's been a positive risk premium in every 20-year period. So it's just important to think about this, because you will see people who are trying to make a point with these charts, maybe shift them a little bit. It's just, you have to ask yourself, what am I seeing here? None of them are the wrong way to do it. It's just, you have to ask yourself, what am I seeing here when I see a chart like this?
Back to the why am I reading this now question, and back to the chart we just talked about before with the free cash flow and the valuation metrics over time. You really want to read what the chart is showing you. Spend a lot of time when clients see something either in another report or somewhere else, some business journal or something of interest, and they'll go like, hey, what does this mean? And you got to kind of unpack. And this is where you just need those critical learning skills, critical analysis skills to be able to dive into something like this. Because yeah, if I adjust this, if I don't use nominal returns, If I add in inflation, it's going to look different. If I look at relative returns, if I change the benchmark from S&P 500 to something else, these are going to look different. Understand what data is being presented with you. And yeah, guess what? Large companies in the United States, they've also had a pretty good run since 1928. Right side of a couple of wars, right side of a couple other situations. These numbers are looking pretty good, but there's a lot of stuff baked into this cake.
And we'll see this idea of like making sure you look at charts in context a lot during periods like this, because we have some clients who, do read the doom and gloom newsletters. And so you will see like them come up with this macro chart of like, whatever, this has only happened twice in history and the market went to hell and like all this other stuff. So it is important to just kind of take a step back with that and say like, who's presenting me this chart? What are they trying to accomplish? Why am I reading this now? Like all that stuff's important to ask when you get those charts, because a lot of these doom and gloom type things are always doom and gloom. And basically in the long term, they're guaranteed to be wrong, but in the short term, they're guaranteed to be right in a big way in, certain times. And so it's just important to keep all that in context when you see it, I think.
I kind of want to start my own, this is a tangent, then we're going to go to the next one. I kind of want to start my own kind of doomer newsletter, and have been so taken by the quality of work that Doomberg puts out is next level. Like there's some next level research and analysis going on there. But I really feel like my response to that could be, I want to do Gloomberg. And I just want to like quote emo and goth bands, like with financial data. I'll just throw like a Morrissey quote against like a CNBC story picture or something. I think Gloomberg could really take off. It's like, instead of the doomerism of being panicked, it's just like things to feel a little bit sad about. Maybe get a sunburn on a sunny day too.
I could do some good YouTube covers for you for that. I could get you a lot of clicks. So I'm very good at doing I don't do them for our stuff because I don't like them, but I could make some really good doom and gloom type of YouTube covers if I have to.
All right. My Gloomberg idea might be getting the green light. We'll see. If this market continues to be in turmoil, I might go full Gloomberg on you. Watch out.
So just a few more as we wrap up. And this is something that I think is really important as we think about clients calling us and stuff. And I was just talking to a client about this the other day. And this idea that, conviction is so important in investing. And it's really important that we don't look at this in a spreadsheet. It's really important that we look at this as, what do you, the client, believe? And have we aligned your portfolio with that? Because when you have these periods where the market goes down, you're much less likely to question that. You're much more likely to stick with it if it's whatever you believe. Even if it's not the perfect thing that I put together, in my quant modeling software that says, this is the optimal portfolio. Like, even if it's, far from that, if it's a reasonably intelligent investment strategy, and if you believe in it, this is the type of period where that conviction gets tested. And, I even, that's probably a little extreme for me to say that, because this is not even that much of a decline. I mean, you could have way bigger periods where it gets tested, but this is like a small example of that getting tested. And as I always say to clients, like the most important thing is that you understand why we're doing this, that you believe in this thing, and that during periods like this, you're not going to make changes because of it. And if you feel like you have to make changes, then we probably should have you in something different, even if this thing looks better on a spreadsheet.
Conviction is always a function of confidence. Confidence is always a function of your trust in the people you're doing this with, and the people you're around, and the data that you have at your disposal. When we look at conviction as being essential, what we're really talking about is we're looking at our conviction in, is this going to work over the time horizon I need it to? And how do I know this is the time horizon I think I need it to? There's nothing better. I love the reality of a situation where a client wants to do something. We go, maybe, why don't we'll show you the numbers. It's your money. It's your decision. Ultimately, we're not necessarily recommending that or pointing that out as something that seems obvious, but we're happy to work through with you. And then one of the greatest feelings in the world is like working it through with the client, and the client going like, oh, this kind of seems like this is a more complicated way to get to this same place. You're like, yeah, that's how we came at it too. And then realizing, like, again, conviction is a function of confidence. So it's okay to test your convictions. It's okay to have stuff like this remind you of why your confidence is in place in the first place. That can be one of the gifts of living through a bunch of these bumps and, giant VIX spikes and terrifying news cycles.
And I think that's important too, because your conviction has to be in something that makes some degree of sense. Like if I have a client who has conviction in buying companies with the highest debt that are on the verge of bankruptcy or something, like I probably should be guiding them away from
a value investor?
Or
systematic value investor? Is that what you're saying?
Exactly. I should probably be guiding them away from that and saying, that's a strategy that over the long term doesn't work. But if you've got two strategies that are close to each other, or two strategies that do have reason to believe they will work, the one that you believe in is usually going to be better than the other one, even if the other one might show better returns on a spreadsheet or something like that.
Yeah. And as you can see by my crypto fundamentals in that analysis check, all I can do is buy these meme coins until.
So my next one I'm going to steal from you, actually, from our last episode with Jack Schwager, because the way you put this, I really like the idea, because you have people in these types of periods that want to make binary changes. And the temptation, both as a person and as someone who advises those people, is to say, that's just stupid. You shouldn't make those binary changes. That's ridiculous. But the reality is sometimes making a small change during a volatile period is better than the binary choice of going all in or all out. And even if the right choice is to do nothing, sometimes a small choice can prevent the really wrong choice. And so I think I like the way you put that. And I think it's really important to think about that. Like, even if you're somebody who doesn't use an advisor, who manages your own money, and you're just feeling this temptation to make some major change, a lot of times the best thing to do is take a step back and say, well, if I make this small change, I'll feel like I did something in response to this. I'll feel better about it. I'll avoid making the large change. I think that can be a better way a lot of the time.
And you can make a small change back to the conviction confidence thing. You can make a small change in something where you still have a high level of confidence in the thing. It's probably okay if you added to an index fund or to a large cap tech stock or something else in the wave of this market volatility. It's okay to do that little thing that is directionally oriented in the direction you're going with too. On a big market decline, if somebody wants to add to a single position or add to something, it's like, oh, are you still buying something that the expected returns with a below average result is now caught up again? Like, these are okay. That's a tiny way to rebalance. It's not an exact way to rebalance. It's not the mathematically optimal way to do it, but emotionally, it might have a very small impact on the long-term results, but it might have a very big impact on reminding of why you have the conviction and the confidence in the strategy that you're laying out. That is tremendously important. I think if you know this inside yourself, you can definitely do this if you're managing your own money. You don't need another person to do this for you. I think it's helpful, even if you're managing your own money. This is where it's good to have a community of people with similar thought processes around to bounce this off of. The bogleheads are probably doing a lot better in volatile market environments than, the Yahoo message boards or whatever the equivalent of that is today. And I think that's the other thing too. Like the benefit of, if you're doing it yourself, you have other colleagues that you like, respect, and trust who have similar things they're trying to accomplish. Great. If you don't have that, there's a real value in working with a professional or an advisor or somebody who can also just say, like, I have your long-term interests in mind too. Let's try to find the smallest way we can keep moving towards that track and just rebuild that confidence and that conviction in the right direction.
So as a good example is, like, I had a client recently who was very panicked about what's going on and wanted to make some significant changes. And like, after talking about it for a while, what we settled on is the client has like a higher risk strategy they're in, and they have a lower risk strategy. Well, and they're taking withdrawals from the account. What we said is, we're going to sell the higher risk strategy for a little bit, for a short period of time. We're going to start taking all the withdrawals out of the higher risk strategy. Now, you could argue that's not the right thing to do, because in declines, you probably want to be selling the other thing. But if it makes you feel comfortable, that's a good way to that's a very small change in their allocation around the edges. It's not going to make some huge difference in their long-term returns, but they feel better about it now. They feel like, all right, I'm taking risk. When I take my withdrawal every month, I'm taking a little bit of risk off the table by selling the higher risk strategy. That's the way, but even if it's not the right thing on a spreadsheet, it's the right thing to do for that person. They'll do better that way than they would have if they had made some major change.
And functionally, this is the overlap between financial planning and investment management, because effectively what you're doing is you're rebalancing for sake of consumption away from the higher risk one than the lower risk one. But I mean, I would also venture to guess the higher risk one does have higher expected returns over the long run.
Oh, definitely. Yeah.
But I'm sure, like, over a medium term period or other periods, I bet there's plenty of times where they overlap, where one's leading and one's lagging, and it probably flips, right?
Yeah. And we're also talking about like single percentage points in terms of the total allocation change that this will do. Right. It's not enough to really matter. But what does matter a lot is how the person feels about that this is happening right now. They feel like something is being done about this market volatility. And if that's what you need in order to avoid the big change, then that's what you should do.
Yeah. It's not like they're coffee canning the money in the backyard all at once. They're just saying, like, let's just go from here to here, versus coffee canning the net worth, which just don't do that.
So as we close out, we had one more here, and this is just something I think about a lot, because we try to do this with education up front, but I think it's really important to ask with any strategy you're in, like on the downside, what are my expectations in terms of what that downside might look like? So to give you an example, like if somebody's in a 100% equity strategy, they probably should expect they're going to lose 50% of your money at some point. If somebody's in the permanent portfolio, if you look historically at the permanent portfolio, the max drawdown may be, 10, 15%. I think it set the new max drawdown in 2022, but it's something like that. So at least that gives you some context when you're seeing something like this and you're seeing what's going on. Like, what do I expect was a bad scenario and what's actually happening? And that works in factor investing too. Like you want to know, when does my strategy do poorly and how poorly do I expect it to do? Not that history can't, the future can't be completely different than the past, but at least gives you some context. If you have context about how this portfolio behaves in different scenarios, what the bad scenarios look like, you do a lot, having that education up front, you do a lot better.
I'm going to add to that explanation. So I think knowing the downsides of your strategy itself are really important. And then you have to map those over the stage or phase of life you're in. And I think it's the wedding of these two things. It's an incredibly important concept. This is one of the things where it's like, I'm incredibly grateful to the experience of like the career that I've had so far to live through this with so many different clients. It's the big difference of, just going through life. You're a kid, you fall, you break your arm, you have a cast, but you're a kid, you're still growing. Like my wrist still works, broke it twice, still works, had the cast, could easily just, off the top turnbuckle to, my brother hit that cast. Like it was a bonus in so many ways after the initial healing was done. When you're growing, that's okay. But if you're 80 years old and you fall at home and you break that wrist, it's a different calculation. It's the same downside. It's still the same broken wrist, but the recovery period, all the different things have different ramifications. It's the same thing. If you're saving for retirement and you get a decline, each incremental dollar you add is going to go further. But if you're in retirement, you're spending that money, if you're thinking about shifting between strategies and you're on the consumption path, this means something different. So you want to know the downsides of the strategies that you're implementing, and then you want to map those downside back against the life that you're living at that point in time and just say, is this the kind of thing I can recover from? What safety measures do I need to put around it to give me often just the time to recover? But what other cushions do I need to build into my plan, into my broader strategy? Because to your point, if you're a stock investor, you're probably expecting at some point to deal with a 50% drawdown. If you're a permanent portfolio or a diversified investor, you're still thinking, how do I survive a 20% drawdown? You got to give that context, and you got to think about, where am I in my journey? Am I on my way up the mountain, accumulating? Am I on my way back down the mountain, accumulating? Am I rolling that Super Bowl down from the top of the hill? We're going to go bing, 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 boom, and see what happens. Know the downsides, but map it with context on where you are in life, and know that life changes and evolves. You got your own wall of worry to climb, Jack.
Yeah, well, that's so important too, because marrying those two things, like for instance, if I'm someone who's like just retiring, I have a pretty high withdrawal rate, sequence risk is at its absolute highest, and I own 100% equities, well, just knowing that I have a 50% downside is not doing me any good. It's great that I know that, but obviously things can go really, really against me with that, and I probably shouldn't be in that in the first place. Like Portfolio Visualizer used to have this thing called, it was like drawdown plus cash flow or whatever. So in addition to just looking at, the drawdown of the portfolio, it was looking at what would your drawdown have been, including your withdrawal rate. And I thought that was eye-opening, because you could see, in a lot of cases, in financial plans, when you run those, it can be 100% because you get the drawdown at the wrong time. You're pulling out your money. The max drawdown plus cash flow becomes 100%. You ran out of money. So I thought that was an interesting stat that I think sort of gets at what you were talking about.
Yeah, super important. If you want the deep dive in this, the interview we just put up with Wade Pfau, we get into a lot of the academic studies on this stuff. It's super important, super useful to know. I can't stress it enough. It's just, this is investment management in the real world. We talk a lot about the academic theories and the numbers on how this stuff works, the statistics behind them, but you're still a real person messing with this thing. Light off all the fireworks you want. I'm getting old. I'm going to try not to carry as much yen as I used to.
It's probably a good idea. Well, we
a little bit less yen in my own.
We actually got this thing in under an hour, Matt, which we never do. So I'm going to go ahead and wrap it up so we can actually see this before the hour mark turns. But thank you everybody for joining us, and we'll see you next week.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.